Okay, so now we're moving on to part 3, which is my macro outlook. Okay, so where do we start? Let's start with the central bank. So if we look at last week, so the ECB hike rates 25 basis points, so they're now at 4%, so they've hiked 4.5%, and that's their 10th consecutive hike. So they've pretty much sort of suggested that it's going to be their last one. When they hiked rates, the euro had a bit of a rally. And as soon as the outlook was that they wouldn't be raising rates anymore, bang, there was a massive sell-off on the euro because of that. And of course, it's still a wait and see because energy prices are rising. So we could see inflation flip that little bit higher. As I mentioned before, it does take time for these rate hikes to be fully felt in the economy. Even up to probably early next year for these final ones to sort of feed in. It can take up to a year. And of course, with Germany struggling, it may be one of the factors why the ECB will stop hiking as well. It's a little bit of a telltale when your biggest economy is struggling, surely. So this week we have plenty more central banks with all eyes going to be on the Fed, with expectations that they're going to hold, but warn that if inflation does turn or continues to be that little bit sticky, that they could add one more before the year end. And again, you'll see that in the dot plot. So, after the rate announcement and everything, just look at that dot plot and see where those dots are. Each dot represents a member of that committee, their vote with their expectations for the rest of this year, next year, the year after, and the longer term as well. So it does give some good insight. And then, of course, we've got the Bank of England. They're expected to hike. It's not a given, it's not a guaranteed yet, but there is that chance. Again, that UK inflation just remains that bit too high. And then, of course, we've got other rate decisions coming from a variety of other central banks: China, Japan, Switzerland, and also Norway and Sweden, which are both likely to hike probably by 25 basis points. Now, oil's continuing to rally, and that may just sort of make inflation a little bit trickier. It might just sort of muddy the water regarding if we have seen the peaks or whether there will have to be one more hike from some countries, especially if they're energy dependent. WTI hit $90, finished the week strong. So, obviously those OPEC cuts are working now, especially as reports that demand will stay that bit higher than previously expected. Friday was quad witching, and that, along with data, sent stocks into free fall in the afternoon. So it actually sent gold and Bitcoin higher, and the dollar ended the week strong too. In fact, as I mentioned, after the ECB raised rates, the euro had that tiny little rally, and then it got smashed when they said that basically that was probably the end of rates. And also the pound. The pound's been dropping as well. That's below 124 now, but that is dollar strength, as you can see. And as I keep writing and I keep posting, with that US economy remaining so resilient, for me the dollar's been undervalued in recent months, and I've been mentioning that almost week on week, but I think probably now it's getting back to a more realistic level. Of course, inflation data this week, along with the central bank meetings, will determine where the dollar goes next. Just remember that dot plot. Excuse me, that's going to be a real key impact for the dollar and for stocks potentially as well. Now, a couple of negatives in the US though, so it's not all sort of rosy. So we've got Detroit car workers are striking. That's going to be affecting Ford and GM. And US consumers expect inflation to continue to drop, but with higher energy prices, maybe it will be a surprise for them that it won't. Now, as we near 2024, we will potentially see sort of households and corporations having to refinance, from loans that are maybe at fixed rates or something from 2-3 years ago, sort of around COVID. And of course, when they're refinancing, they're going to be paying probably more than double the interest rate payments that they've been having to make. And of course, that is going to potentially have another impact on demand, and possibly on firms spending money as well. If they're having to spend more money financing their debt, then that's going to give them less to invest. If we look at Mexico, it's benefiting considerably from America's cutback on imports from China, and is now the US #1 trade partner. And again, despite a drop in global demand, China's economy looks to be stabilizing. That's just based on recent data. Retail sales, factory orders were sort of beating estimates. House prices still are a problem, though. They continue to drop despite the government reducing sort of the mortgage rates, the lending rates, and injecting stimulus, and that's for the 10th consecutive month that they've been doing that. So finally, rate hikes may be ending. Inflation is slowly falling, so expectations will increase for rate cuts in 2024. I think that is possible. With the impact of higher rates fully hitting the economy, costs up, savings depleted, you've got to expect that demand will fall. Especially, because we've still got that corporate greed, which is preventing lower prices. They would rather, at the moment, sell less, but for a higher price. Which is, completely the opposite of the old business model that they used to have. But, they're working on big profit margins, into the high 20%. So, that's in some sectors. So, they can afford to sell less if they're getting that as a profit margin. I still maintain buy local, buy from your local suppliers where possible. Those independent suppliers, help them. You're probably not paying any more at the moment than you would in the supermarkets, perhaps, or anywhere else. So, and just reduce that demand for these titans, and just show them that they need to sort of be more helpful to the consumer. Now, big question's going to be, when in 2024 should we expect some rate cuts? Now, I think this is going to depend a lot on which country you're looking at, what one you're focusing on. I think for the Fed, they're going to be very cautious, and any cuts that come out are going to be slow, they're going to be deliberate, and they're going to take a lot of time deciding on that, to ensure that if they do start to cut rates, it's not going to boost inflation again, because of increase in demand. I think they're still on for a soft landing. Therefore, I expect probably the first rate cut in the US to be in the second half of 2024. Just remember, this is all just my personal view. That's all. I'm not giving you recommendations or anything. I'm just trying to give you my view, using my 50 years in the markets. So 10-year yields are currently around about 4.2%. Again, so anyone having to sort of refinance are going to be paying probably more than double what they were 2-3 years ago. My biggest concern is Europe. When we look, Germany struggling, and for me, that's a sort of like a big alarm going off that, potentially that recession is nearing, even though ECB still raised rates again last week. And I place a lot of emphasis on the potential that there could be a colder winter than last. And if that's the case, with increasing energy demand, that's going to push up gas prices. You know, plenty of storage at the moment, I'm sure, but even so, it's going to increase that demand for gas. And of course, we've already got oil over $90. So, you know, in Europe especially, I would say watch unemployment data closely, because I can see that starting to build as well. And I doubt the ECB will be concerned about reversing policy, as with the Fed, but I can see them possibly cutting rates before mid-2024, and that is as long as inflation continues to cool. Now, UK economy is again sort of holding up despite sort of sticky inflation levels, but you know, in the UK, once inflation gets a hold, it does really take time for it to come down. I mean, you just got to look in sort of the 80s and 90s and see how bad that was. You know, I'm old, so I've seen all that. I experienced all that. And of course, sort of, it stays there for longer than most of its peers. It's going to be a close call for the Bank of England Thursday. You know, will they hike one last time, or will they try and hold off and just hold that in case they need it at a later date? I'm not too sure there. I do partly expect them to hike, but you know, it is pretty much a 50-50 at the moment, I would say. And again, you know, the temperatures over winter could be really the deciding factor for Europe, including the UK, if there's going to be a recession. Of course, the unknown then is for how long and how deep it's going to be. Now, I've been commenting for you know, probably since the end of last year about central banks fearing inflation more than a recession. You know, they've really struggled to regain control of inflation. But of course, that's due because most of it was being generated, you know, initially by sort of supply chain issues after COVID. And of course, you've got to add into this the amount of stimulus that these governments and central banks have actually added. It's in the trillions. And then, of course, after we was all released from the lockdowns, that added explosion of demand came through in all areas. And of course, just mentioning COVID, so it is still around in the background. We are seeing different mutations and it's still spreading. You know, is it going to be another pandemic? Let's hope not. Now, I would say that really, you know, we've just got to accept COVID. I think you can almost batch it up with colds and flu now. And, you know, just have to accept that it's going to be around with us. It's probably not going to disappear. So anyway, back to the market. So the stock markets, although probably holding up better than expected, for me, they are looking a little bit more vulnerable. And you saw that Friday afternoon. You know, especially if you watch the Russell 2000. And the reason for that is because they're the small cap stocks and they're so much more sensitive to what the consumer's doing, you know, their actions. And of course, higher interest rates impacts them a lot quicker as well, because they're generally borrowing. And if you look at the Russell, it is really underperforming, especially when you sort of compare it against the Titans that have driven up the S&P and Nasdaq all year. So I think moving forward, I'm going to put a lot of focus on debt. You know, that's household, corporation, government, you know, and mainly because a lot of those old cheap loans that are sort of expiring from where they are, you know, whether it was a fixed term or whether it was just a fixed beginning of that debt, when they go on to a variable rate, you know, they are going to be much more expensive. You know, possibly the repayments at least double what they were. And again, I think that's probably going to lead to a reduction in spending and also an increase in defaults. So that's sort of pretty much where I am on the macro outlook at the moment. Of course, you know, as always, it can change very quickly. But and this week, all these central bank meetings are probably going to give us some really good insight into what to expect for the rest of this year. So I hope you enjoyed that, and I hope you'll stay with us for part 4, which is our chart analysis on multiple asset classes. So we offer newsletters, we offer workshops, 1-week courses, our comprehensive masterclass that's really going to help you. You know, apart from gaining all that fundamental knowledge, you get to spend 20 trading sessions with me, practical sessions. So, you know, that's you know, I'm not saying I'm going to turn you into a massive trader in 20 sessions, but you know, getting that sort of feedback from me, that insight from me, is valuable. Now, other things that we offer are trader mentoring. We consult to companies on FX and commodity exposure. Of course, we provide a massive educational content to individuals, exchanges and brokers. If you feel underfunded, why not give the trading challenge a go, and see if you can get that funded account. You know, maybe you're underfunded, maybe you don't want to risk your capital, which is quite understandable. And of course, one of our courses now includes a free attempt at the trading challenge. If you would like to find out more about anything, then contact us at info@symaxfintech.com or directly to me at chris.tubby@symax-int.com. Okay, so now we're going to go into the technical analysis section. So I hope you join us for part 4.